Tech wreck, blood on the street. The financial world is in turmoil as tech stocks take a nosedive, leaving investors in a state of panic and uncertainty. The once seemingly invincible tech sector is now facing one of its toughest challenges yet. Tech stocks are getting hammered. The relentless selling pressure has wiped out billions of dollars in market value, and the ripple effects are being felt across the entire financial ecosystem. Traders are scrambling to make sense of the chaos, and the atmosphere on the trading floor is nothing short of frantic. It's a bloodbath out there, folks. Investors are watching in horror as their portfolios shrink, and the fear of further losses is palpable. The dramatic decline has left many wondering if this is just the beginning of a prolonged downturn. The Nasdaq is down big, and the once mighty tech giants are feeling the pain. Companies that were once the darlings of Wall Street are now struggling to maintain their footing. The sharp decline in stock prices is a stark reminder of the volatility that can come with investing in the tech sector. Remember the days when tech stocks could only go up? Those days are over. The euphoria of the past has given way to a harsh reality check. Investors who once enjoyed seemingly endless gains are now grappling with significant losses, and the mood has shifted dramatically. The market is shifting, and investors are getting nervous. The uncertainty is causing many to rethink their strategies and consider whether it's time to cut their losses or hold on for a potential rebound. Financial analysts are offering a range of opinions, but the consensus is clear. The road ahead is uncertain. We're seeing a major correction, and some are even calling it a bubble bursting. The rapid rise and subsequent fall of tech stocks have led to comparisons with past market bubbles, and the debate over whether this is a temporary correction or a more significant downturn is heating up. But is it really the end of the tech boom or just a temporary setback? The tech sector has faced challenges before and emerged stronger, but this time feels different. The combination of economic uncertainty, regulatory pressures, and changing consumer behavior is creating a perfect storm that could reshape the industry. Let's dive in and find out. In this episode, we'll explore the factors driving the current market turmoil, hear from experts on what they believe the future holds, and examine the potential opportunities and risks for investors. Stay tuned as we navigate the turbulent waters of the tech wreck and uncover the truth behind the blood on the street. The Magnificent Seven Titans on shaky ground. These 7 companies have been the pillars of the tech industry, shaping the way we live, work, and communicate. They have been the driving force behind the technological revolution, pushing boundaries and setting new standards. Apple, Microsoft, Amazon, Google, Meta, Nvidia, Tesla, the Magnificent Seven. Each of these companies has a unique story of innovation and success. Apple, with its sleek designs and user-friendly interfaces, has revolutionized personal technology. Microsoft, a pioneer in software, has become a household name. Amazon, the e-commerce giant, has changed the way we shop. Google, the search engine behemoth, has made information accessible to everyone. Meta, formerly Facebook, has transformed social networking. Nvidia, a leader in graphics processing, has powered the gaming and AI industries. Tesla, the electric vehicle trailblazer, has redefined the automotive industry. These companies were on top of the world, driving the tech market to new heights. Silicon Valley became synonymous with innovation and success. The offices of these tech giants buzzed with activity, attracting the brightest minds from around the globe. They were not just companies, they were symbols of progress and the future, but even titans can stumble. The tech industry, like any other, is not immune to challenges. Market dynamics are constantly changing, and what goes up must come down. The recent fluctuations in the stock market have shown that even the most powerful companies can face setbacks. Their stock prices have taken a hit, some more than others. Investors who once saw these companies as safe bets are now reevaluating their positions. The market's volatility has led to a sense of unease, and the once unshakable confidence in these tech giants is being questioned. The days of easy growth seem to be over. The rapid expansion that characterized the early years of these companies is slowing down. Empty office spaces and deserted startup hubs are a stark reminder that the tech industry is facing a new reality. The challenges are not just financial but also operational as companies navigate a post-pandemic world. Competition is heating up and the economic outlook is uncertain. New players are entering the market and existing competitors are stepping up their game. The economic landscape is shifting, and the tech giants must adapt to survive. News headlines are filled with stories of economic uncertainty, adding to the pressure on these companies. Investors are starting to question their sky-high valuations. The astronomical valuations that these companies once enjoyed are now under scrutiny. Investors are looking for solid returns and are wary of overvalued stocks. The boardrooms of these tech giants are filled with discussions about how to maintain growth and justify their valuations. Are these companies really worth what the market says they are? This question is at the forefront of many investors' minds. Financial news anchors and analysts are debating the true value of these tech giants. The fluctuating stock market graph is a visual representation of the uncertainty that surrounds these companies. Let's take a closer look at those valuations and what they mean for the future of these tech giants. Understanding the factors that drive these valuations is crucial. It's not just about numbers, it's about the potential for future growth, innovation, and market dominance. The future of these companies depends on their ability to navigate the challenges ahead and continue to lead the tech industry. Sky-high valuations. Are we headed for a crash? The stock market has been on an unprecedented bull run, with valuations soaring to new heights. Investors are pouring money into tech stocks, driving prices up to levels that many experts believe are unsustainable. Price-to-earnings ratios, or PE ratios, are through the roof. These ratios, which measure a company's current share price relative to its per-share earnings, are often used as a gauge of whether a stock is overvalued or undervalued. When PE ratios climb too high, it can be a sign that the market is overheating. Some tech companies are trading at multiples that seem completely detached from reality. Companies with little to no profits are being valued as if they are already industry giants. This kind of speculative investing can lead to dangerous bubbles. This kind of exuberance can't last forever. History has shown us that markets driven by speculation and hype are often followed by sharp corrections. Investors get caught up in the excitement, pushing prices higher and higher until the bubble inevitably bursts. When valuations get too high, it sets the stage for a painful correction. A market correction is a decline of 10% or more in the price of a security, asset, or financial market. While corrections are a normal part of market cycles, they can be particularly severe when driven by speculative bubbles. We've seen this movie before, and it doesn't end well. Remember the dot-com bubble? In the late 1990s, investors were similarly enamored with tech stocks, driving valuations to unsustainable levels. Companies with no profits and questionable business models were trading at astronomical valuations. Companies with no profits and questionable business models were trading at astronomical valuations. When the bubble burst, it led to a massive sell-off, and many investors lost their life savings. The fallout was severe, with trillions of dollars in market value wiped out almost overnight. Then the bubble burst, and investors lost trillions. The dot-com crash serves as a stark reminder of the dangers of speculative investing. It took years for the market to recover, and many companies never regained their former glory. Are we headed for a repeat performance? While it's impossible to predict the future with certainty, there are troubling signs that we may be in the midst of another bubble. The rapid rise in valuations, coupled with the influx of inexperienced retail investors, has many experts sounding the alarm. It's too early to say for sure, but the warning signs are flashing. Investors should be cautious and consider the risks before jumping into the market. Diversification and a long-term investment strategy can help mitigate some of the potential downsides. Let's see what role AI plays in all of this. Artificial intelligence and machine learning are increasingly being used in trading and investment strategies. While these technologies can provide valuable insights and help identify trends, they also come with their own set of risks. Over-reliance on AI-driven models can lead to unforeseen consequences, especially in volatile markets. AI-driven trading algorithms can execute trades at lightning speed, often outpacing human traders. This can lead to increased market volatility as algorithms react to market movements in real time. Additionally, the lack of transparency in some AI models can make it difficult for investors to understand the underlying factors driving their decisions. We've seen the impact of algorithmic trading before, such as during the flash crash of 2010, when the Dow Jones Industrial Average plunged nearly 1,000 points in minutes, only to recover shortly after. This event highlighted the potential dangers of high-frequency trading and the need for better regulation and oversight. As we navigate these uncertain times, it's crucial for investors to stay informed and make decisions based on sound financial principles. Diversifying investments, understanding the risks, and staying updated on market trends can help protect against potential downturns. Long-term investors should focus on building a balanced portfolio that can weather market fluctuations. While the allure of high-flying tech stocks can be tempting, it's important to remember that sustainable growth often comes from a diversified mix of assets. In conclusion, while the current market environment presents both opportunities and risks, a cautious and informed approach can help investors navigate potential pitfalls. By staying vigilant and making well-considered decisions, we can better prepare for whatever the future holds. Stay informed, stay invested, and remember that the key to successful investing is not just about chasing the next big thing, but about building a solid foundation for long-term financial health.